Alright, so this video is going to be very off the cuff and just very ranty and maybe even poorly edited, so I apologize for all those things. I'll do the best in case I fuck up. But I'll get to it and say I'm not trying to be an alarmist here. I've just noticed some stuff in the research I've been doing, specifically that in the financial markets, because that is what I study. But I've been noticing a trend that we are going towards a more volatile market. That is to say, a riskier market. A market that has the economic conditions of another recession or another bubble burst, which pretty much leads to a recession. Specifically in the corporate debt sector and the treasury bond sector. And if you don't know what bonds are basically debt. So whenever you hear the word bonds, just think of debt. And if you look at the trends recently, corporations have just seen massive amounts of debt. 75 trillion in debt. It's insane of the amount of debt that corporations have incurred. The government has obviously issued more bonds. It has hit 3%, which that means more inflation, more volatile economic condition. Those bonds don't get paid off, then what could happen in the 07-08 recession could happen very much today, though not in the housing market sector, but in the corporate debt sector. Inflation is a bane to bondholders. It erodes the value of their fixed payments or their fixed income, which is a very important thing, and it is seen as a not risky thing to invest in bonds and stuff, which they said the exact same thing about the housing market back in 07-08. And the Fed keeps on planning on increasing inflation to keep up with this. Higher bond yields means riskier stocks. I mean, there's a threat to the stock market from rising bond yields. While investors have increasingly shrugged off expensive stocks in recent years, there's been solid earnings, low interest rates, which is why people are having more bond yields. As the yields and inflation rise, earnings might not be enough to propel stocks higher, and this is going to lead to a very risky market, a market where there really isn't any other commodity or thing to invest in because Google and Facebook are in hot water right now. Oil companies are in hot water right now, and oil is a depleting resource, period. So who knows how strong oil can stay. But there's just a strong, conviction I have through my resources and through my research. And I am by no means an expert. I have flung this by a few people, and they have agreed that is a good observation. And I would like to point out that this is a mere observation, a hypothesis, but it is founded with sources and fact, and I recommend that anyone to look through this information that I have provided in a description in other places, and just really look at it yourself and come to your own conclusions. But rising bond yields have been historically tied to recessions in the past. I mean, this is exactly the type of volatility that will push down EPS, earnings per share, and dividends obviously might look good, and people might go for the fixed income, but these things will become riskier over time. And while it's seen as a stable market right now, the bond market, the housing market was seen as a very stable market, and that collapsed. And while I think housing has gotten a lot stronger now, construction a little bit more so, especially in places like China, which is why Trump starts these trade wars, there's, a bigger hit on commodities, which is why investing in commodities and raw materials will be more riskier. We're going to a more risky economy. There's not going to be anything that changes this. Will it definitely lead to a recession? Somewhere down the line, for sure. It's not an if question, it's a when question. Do we know it's going to be 2 years, 5 years, maybe 10 years? Possibly. Recessions have historically happened from every 5 to 10 years. No one knows for sure. And to notice a bubble burst, you're going to have to look at where the money is moving. So, for example, they might move their money out of the bond market, but they might try to go into some place like water or some other commodity that will see an increase. So you have to see where the money is going in these markets and how they really kind of affect our grand economy as a whole, because The second the U.S. economy enters a recession, that millions of people are going to lose their job. People are going to go unemployed. And just the amount of dry throat. The amount of debt that even the average citizen has accumulated, like, there's going to be a point where people are going to pay that off, just like they didn't pay off their mortgages in the 07-08 crash. And right now, bond yields have been seeing a bull market, that is to say, a good market, but there's a lot of speculation that we might go to a bear market, which is a really bad. And we have seen a market that's going through historical highs and lows, more so than even in the recent years. It's just the selling pressure came right after the 10-year treasury yield briefly touched the 3% level for the first time in 4 years. And it's a move that comes as first quarter earnings season was failing to excite investors despite some strong results. Like, we're seeing a drop in the stock market from the bond market, and this will likely affect the entire economy as a whole. Investors will likely get spooked, and commodities will get more expensive due to trade wars and all other things. And I feel like this is sadly just going to affect poor people again. This is going to fuck over the working class. This is how our economy works, though. It needs recessions to keep functioning. And the inefficiencies of the market system are shown apparent by surplus and shortage, boom and bust. It does not distribute things equitably or fairly. There's no fair distribution in the market system. It goes to the top as always. It does not trickle down to the bottom. It has never trickled down to the bottom. It has stayed at the top. And these people are betting on bonds, which is negative money. 60% of all capital in our economy is debt. Think about that. Over 50% of all capital is basically an IOU. And then there's people that bet on that and make a fixed income off of that. Which is crazy, because once the bond market crashes, which it will inevitably become ballooning due to the massive amounts of corporate debt we have incurred. And this is going to happen. And I do not mean to sound like an alarmist, and I really don't think I am trying to scare the general public. I am trying to inform. And just look at the ridiculous valuations that equities currently have, and the liabilities that debt have. Then look at the amount of corporate debt that's currently issued. Now ask yourself, when was the last time that borrowing costs were at such low levels for a decade straight? I mean, it's honestly scary stuff. You don't need a news article or some fucking random dude on YouTube to tell you that artificially low interest rates have spurred a giant bubble. A lot of companies have been borrowing just to pay dividends or to buy back shares. And add in the factor that central banks are winding down their stimulus from the 2009 recession, and it's even scarier. I mean, Donald Trump is even thinking about repealing the Dodd-Frank Act, which is going to put us in the pre-07-08 economy, which is extremely volatile, the fucking risky as shit. So truthfully, no one really knows what's going to happen, or when the recession or bubble burst is going to happen. But this whole experiment known as quantitative easing, which is basically the government selling assets at a much lower interest rate, is uncharted territory. We honestly don't know what's going to happen. And once again, it's going to be working class people that are going to get shafted, and we're all going to have to pay, but the rich will still get richer. And this is how the market system works. This is the efficiency of the market system, is to keep producing these recessions and these bubbles, and to keep allowing just this broken system to take place. And that's going to keep happening until people wake up and realize, hey, this isn't a correct system. There has to be a better system. There has to be.